Welcome to the Pump and Dump channel for another video. This time talking again about some stocks. As usual, not investment advice or recommendations to buy. I've not done a video for a while. I probably should have been more active. There were lots of good opportunities during the last month to bounce into stocks like CNX and get it for 9 to 10 and then selling it for 11 to 12 when there was this takeover bid rumor that was started, which made no sense. But getting to first thing first. So Alliance Resource Partners here, 376. I've decided today that it makes absolute sense to sell it because the fundamentals have deteriorated the way I see it. I mean, the natural gas price for next year is around $3 an MCF, and you would say that, yeah, I mean, given that, coal prices should go higher. But if you look beyond 21, the natural gas price is going down again, and therefore, outside of some good earnings for a few quarters, Alliance won't really have a good impact from that coal segment longer term. And then with the oil and natural gas royalties, that that looks good. Don't know really what to think about it. I mean, they do have quite a good a good land position, let's call it, quality acreage and so on and so forth. But unfortunately, given where the oil prices are at, they're not going to get as much as they would be hoping for. Of course, it's going to be positive, but it's not going to be as great as they would like it to be. And I think given that the associated gas from oil production, that theory that has kind of made its rounds, that's it's kind of not like working out the way I see it anymore. I think what has happened in third quarter in the earnings calls, the presentations, the conference calls that go with it, the earnings reports. The trend I'm seeing right now is that the oil producers, the oil and gas producers, those who can, they are shifting from producing oil to producing natural gas, and that means that they'll be trying to fill that void that the market is perceiving, and they will produce the natural gas that the market is asking for at $3 an MCF. So the outlook here is that natural gas won't be in a shortage. I mean, I think it was Shell, or was it Total, who are like re-gearing their business towards natural gas, and of course you have BP, who's now trying to move towards new renewables. I mean, a thing here is quite simple, that I think even though it's in an upwards trend, and I think it probably go higher, but I see the fundamentals in the future, and I just don't think they're so favorable. So I think looking at alternatives where to put the money, I think I have a better idea. So I'm going to sell this one. Next one, Diamondback, I'm going to sell 2. I should have sold this with Noble Energy in the last video when I mentioned that I had recognized I had made a mistake with the with my Excel file, where I had the natural gas liquids prices incorrectly input, far too high, and it gave me a bad reading when I sold some Range Resources to buy it. So I'll sell this too. Reason for why selling it now, even though it's down like 40%, is that the future for next 3 months or so, when we go into Q1 next year, the reality is that looking forward, given how oil prices have performed this year versus last year, the economic reserve of many of the oil producers is going to go down. And with Diamondback, there's sufficient information to come up with a judgment that it's most likely going to be down about 30%, so their reserve is going to decline by 30%. And with the the oil price where it is at now, it's about like 41 or so on the forward strip for this year. If you take 41, project it out long term, it's probably around fairly valued here at 28. But if you adjust the declines in reserves that should come from the lower oil price this year versus last year, it would need a $50 oil price long term to justify this. So it makes perfect sense to sell it here. Of course, I think it could go to 36, but you know, just the way it is. Just gonna have to take it on the chin if it does. So that's kind of the rationale here, is that, you know, the longer term outlook, it's not positive. Of course, I see all these videos of people talking about you need to buy oil producers now, and you know, those people are just looking at the oil price where it is, and they think it will be higher in the future, and it's probably right, but they don't understand how these asset values fluctuate. So they're missing the key thing, which will be, you know, next year when they're looking at their stock, they'll be like, oh, why is it down? Why is it lower than it was last year? The oil price is high, and they won't understand it. And that is kind of, you know, part of what I did in the past when I didn't know what I was doing. And now I do know what I'm doing. I feel much more safe in my decision making, and you know, better understanding, even you know, when things are looking great, that they might not be great. So where's the money going to go from those two sales? It's going to go into PBF Energy, which is a company that owns 6 refineries. They bought one at the beginning of this year, an additional one from I can't remember if it was Shell or someone. It was one of these big oil majors they bought it from in California. And in the last quarter, in Q3, they decided to shut down one of the other refineries, the Paulsboro refinery. They let some people go, and the key decision behind why that was a good decision and why it, you know, has bounced from its low is that previously, you know, prior to the announcement, the market was looking at it and, you know, seeing that they were running their refineries at 70 to 80% utilization. So in theory, if you have 6 refineries and you close down one, you can probably ramp up the other 5 from 75 to like 90% or 95% of utilization. So that obviously will lead to improved efficiencies for the refineries they have operating still, and that could net be accretive. Now the thesis, however, behind why I think that PBF Energy as a refinery is a better play on oil price recovery than let's say a Diamondback or with Alliance Resource Partners, you know, the royalties, why it is better, is that if we just take the year-to-date chart here, we can see that from February, when it was at $28 a share, it went down all the way down to five. I think it went to $5.10, and then it rebounded to 15 here in June. It went down here, and this decline here is obviously explained by the decline in oil price from 65 here in January 8th when it was at 33 to about, yeah, here where at least on the 1 year strip it was at like 30. So what happens here is quite simply thinking about it conceptually. The refinery is a, you know, a bunch of assets. You have the storage where the oil is in, and then you have the different processing stages where the refined good is processed until it comes out the other end as heating oil, gasoline, distillates, jet fuel, whatever. So it goes through the different stages, and the inventory is basically, as a shareholder, what you are buying. You're buying the inventory, you have the cash on the balance sheet, you have the debt against it, and then you have these refineries that may be worth something, they may not be worth anything. And given where the crack spreads are, for most of these refiners, those refineries are worth very little or have a negative value because they're, you know, basically managing to pay the interest from, you know, processing the oil and the debt they have, and then, you know, having maybe sufficient to repay the debt at the end of, you know, when it comes due. So essentially that's what you're buying, is the oil in storage, and the earnings you derive as a shareholder, as a business owner, as a, you know, the debt owner. The earnings that the company makes, it's a function of what the, you know, what the oil price is and the, you know, refined good price, the crack spread, so to speak. But when you're looking at, you know, coming in and playing the cycle, You have to understand that when the oil price goes down like this, the gasoline price is also going down, and because they are highly correlated, and the market seems to assume that a barrel of oil bought today can be immediately converted into a barrel of gasoline, it doesn't take account of the time it takes to take in new oil through the pipelines into the storage and then process it, and I don't know how many days or weeks or whatever it takes to get a barrel of oil processed and well, let's say delivered, processed, and then distributed to where it needs to go. But if you think of it as buying oil and then selling in the future at the point of sale, there is that lag between those two operations. And if the prices are going down for oil and the gasoline price is correlated, you're always buying oil expensive and you're selling gasoline cheap. So, it goes against you. It's not very pleasant to own refineries when the oil price is crashing, because the inventory is going down in value and the earnings you're making are very bad. But on the flip side, when the cycle turns and the oil price starts rising, then you see the reverse. So the theory here is that we need to see gasoline and other refined goods increase in demand, so that not just PBF but also the other players in the industry, they can start buying more and start ramping up volumes. And when they do so, it's going to be like fully directional, one direction only, and be up. And the reason why it will go up is because they'll be buying the oil, because refineries are obviously the primary buyers of oil. I mean, who else is going to buy oil? And you can say the government buys the oil, but that's like, for strategic reasons. They don't process it, they just store it. But yeah, the refineries will start buying the oil. They'll start increasing the amounts, which will mean that the demand for oil will increase, and if there is no production increase immediately happening, that will mean the oil price will start going up. The incentive price needs to be reached, and when the incentive price is reached, the oil price will start rising, more volumes will come. Well, it won't stop rising, but it will start pacing out, and more volumes will come in, the inventory will fill up. And the key thing is to understand is that when they're buying, obviously, and they're buying at higher prices into a rising trend, they're also increasing the value of the inventory at the same time. And as I explained, like the lag between the processing periods here, the idea is quite simply that they'll be buying oil, and by the time it's processed and refined, the gasoline price will also be higher, and they'll have that benefit from the earnings will be rising, and it'll be higher than they had been, especially during the last 6 months or so, when they were like making, who knows, like $2 in one quarter crack spreads, against yeah, against what was it, like 16 or something last year in some of the quarters. So obviously there's that that benefit that once it goes, it goes. Target here, I think 10 is easily doable. I think like it's more likely that PBF will go to 10 than Diamondback goes to 56, to be honest. But I could be wrong, but that's just the way I see it. I just think this is logically the superior choice, and as a consequence, I think that is the best allocation of capital from these two plays, because I don't believe in the associated gas and shortages of gas next year. I see all these other producers increasing natural gas production, and coal. I mean, there's not any new coal power plants being built in the US, and some might even shut down, and that would be bad, obviously, but it's the way it is. And yeah, next here, Dyna Shipping. The idea here is to sell it and to buy Safe Bulkers. I don't know why Safe Bulkers has gone down so much. It doesn't make necessarily total sense to me, but the market seems to think this, so the market must be right. And I will just then do the reverse of what I did last time when I sold Safe Bulkers to buy Dyna Shipping. I bought Safe Bulkers and it didn't move very much, and Dyna Shipping came down, and now Dyna Shipping is doing nothing and Safe Bulkers went down, so I'll just flip and reverse this trade is the idea. So I've already programmed everything in here, so you can see here I'm just adding in all the prices. then I'm taking the what is it? Diamondback, the current value here. I paid I think 2,000 for this, but it's down 700 because I bought it at a bad timing. So that's the way it goes. Then for ARLP, it will be this amount here, and then put down a shipping, and then buying PBF with these two. Then safe bulkers buying with this amount here, so you can see that this 62 in gain that I had will remain 62 even after the purchase. I put in the shares here for PBF and the value, the current value, which will be this one here. Profit and loss. Safe bulkers we have there, and then you see it goes back to 62, and then Diamondback shares down to 0. The loss remains there. Alliance Resource Partners gain here. Dyna Shipping, a small loss. Okay, so with Dyna Shipping I still need to put in what did I do wrong here? Okay, so it's 0 times that plus that. Yeah, I see. Let's remove this here. I put it in the wrong column, that's what I did. Okay, so plus, oops, yeah, plus, there we go, it stays at 29. So let's just check here, 0 shares and 0 current value. Yep, that's all right. Just did all the other prices, you can see there. You can put this 9 red. And this one too. And this one too. So there we go. It's still at minus 3.63% as it was at the beginning before I rebalanced everything. Share counts are what they are. And we'll see then how it goes. One other thing I wanted to talk about here was Range Resources. It was a bad quarter, one would say, but it's not really a bad quarter, because what they did was they postponed some production from this third quarter into the next quarter, and the market seems to be thinking that they produced what they said they were going to produce, and because the balance sheet is not reflecting that, it's kind of reflecting performing less. They adjust it and they just say, well, they lost money this quarter, and then next quarter when the production that's been curtailed in Q3 gets produced in Q4, the market will be like, oh look, wow, magical, they had they exceeded earnings, and they're gonna say that they produced even more than was anticipated, and then probably in January, February there's going to be a big move up in Range Resource from wherever it is, and then it will look like much better than it does now. But anyway, that's why this is down. Yeah, it is the way it is. So we'll see where we get by the end of the year. I'm thinking of extending, maybe doing it next year still, because I kind of think this is funny. Don't need to do too many videos if I'm not too active, because I can give these things some time to work out. Like with good years, I saw that there was a good window to sell it at $10 to $11 a share, and I did in my own account, but I didn't do it here because I was just too busy with other things, and I didn't have the time to record a video about it, so I didn't do it. And I still think the long-term outlook looks good for them, even though the last quarter, it was not so good in my opinion. But I think in the long term it will do fine. There are some other stocks that I really like. I might just make a video about them. If anyone's interested, just leave a comment in the comment section. And with that said, as always, I think I already mentioned it, but it's not investment advice and recommendations to buy these things. You can see that I can make a mistake from time to time, like I did with Diamondback when I paid full value instead of getting a discount when the market was right, and I was wrong because my Excel file was yeah, it was not properly coded, let's say. Anyway, gonna close this video down now because it's probably too long anyway. I'm gonna leave it with that, so have a good day.